A lot of the work that I did before was focused on global systemic risks. One of the concerns that I had that my dad may remember, it was the Christmas right before 2020. This is about 4 months before the pandemic hit. And I brought some charts that I had been working on. There was nothing proprietary in there. It was just, using data from Fred. It was looking at the risk of the financial system as a whole to inflation. And the reason why that's important is because if you look at like the 10-year treasury rate, that is the place where people can go to get what people call zero risk. This is the no risk portfolio. Just buy treasury bonds, right? No risk. At least that's what they were saying. If everybody is not fearful of something, then you should be very fearful. You look at the history of financial crises and how things implode. It tends to happen in places that people view as not risky, right? Housing bubble, people make their mortgage payments, sovereign debt crisis, governments make their payments. So I was looking at what everybody was not afraid of. And while working at the FDIC, I was the liaison to the G20, flying off to Basel and representing the US government with regards to the supplementary leverage ratio, what some call the backstop of the risk-based capital measures. I didn't want it to be the backstop. That wasn't my idea. My bosses told me that, but I really, really liked that after I understood what was going on. They hired me to come on because I was a quant. And at first I was confused because why would you hire a quant to represent and lead initiatives regarding a measure that's supposed to be risk insensitive? The supplementary leverage ratio is a measure of banking capital that is supposed to not be sensitive to risk at all. Liabilities versus assets, like that's it. They told me the reason why they wanted me on this is because my modeling background would help me to argue against everybody that thought you could actually measure risks in the tail. Models work great if you're trying to forecast that which you have seen in the recent past, because the data that you have to create the model is built on the recent past. Even if you go back a few decades, you're still not going to see the impact of inflation and higher interest rates on the actual risk of assets. So I'm showing my dad some of these charts. I'm like, Dad, if we get any sizable amount of inflation, it's going to force rates higher. And a lot of things that people perceive as low risk or no risk are going to implode. Those included corporate bonds, investment grade, especially treasury bonds, long duration. And these things got absolutely hammered in late 2021 and then 2022. Worst losses ever on record. So now what we're seeing is a banking crisis that is being first and foremost caused by held to maturity bonds. If it's held to maturity, you don't have to market to market, which means that as interest rates went up and the bond prices fell, that these banks did not have to recognize the losses. And so it's only now when deposits leave and the bank is forced to liquidate these assets in order to make up for that, that they're starting to show that the emperor has no clothes.
Then they get marked to market.
Then they get marked to market because they have to switch them from held to maturity to available for sale because they got to sell them to make up for the loss in deposits. And why are the deposits leaving? Well, some of this initially has been viral, kind of like GameStop. A bunch of people on Reddit or what have you will say, oh, we're worried about this, so we're going to leave. Whatever the initial reasons were, it doesn't matter. It was a catalyst. But the ongoing catalyst is that the average bank in the United States is only paying something like 0.3% interest on savings accounts.
Yeah.
And yet you've got the Fed funds rate just slightly below 5%. And so you can go out right now, move that money to Vanguard or what have you, buy an ETF of short-term treasury bills. It's still got, full backstop by the US government, but now you're earning near 5% or 5%.
That's exactly what I did.
That's it. Yeah.
I took my money. I was sitting on cash because there was no point because everything was paying nothing. So now that it's paying something, I took my cash out, took the Vanguard, bought an ETF for a short-term bond fund.
So that's probably going to continue, even though the initial catalyst of this bank run, that's not really a concern anymore, given what the Fed's done in the FDIC.
I advised my kids and everyone I knew to do the same thing.
And it's the rational thing to do. Like, why would you not do that? Unless you need the money now. So here we are. with this ongoing movement, because it's going to happen, because if you assume that people are selfish and rational, and they are slowly, at least the selfishness comes naturally, but the rational comes slowly, that you have an ongoing movement away from deposits and into short-term treasury bills. And so you're going to start to force banks to realize losses on these held to maturity, but now moving to mark-to-market trading assets. And as that happens, what's that going to force banks to do? And just so we're clear, 4/5 of all liquid financial assets, not real estate, is bonds of some kind of debt. All right. Equity is a rather small player in this. And then crypto is like less than 1%. And I'm not talking about commodities. It's hard to measure commodities because, like, what's in the ground, what's traded, I'm ignoring that. But given all that, we're looking at a slow moving train wreck. And I think it's going to be slow moving because of what the Fed did. What the Fed did is they said banks can borrow against these assets at par.
Par is the face value of the bond,
Yeah.
like the held to maturity value. Okay.
Yeah. This is the part, this is the face value of the bond. That's correct. So basically, the Fed is creating a window. They said 1 year. I heard a report that it might be 2. It's probably going to end up being longer, just a guess. All right. No inside information here. And the reason why is because they need a slow bleed from these banks, because we could be looking at, from the 6,000 banks out there right now, there could be over 1,000 of these that are already insolvent. If you forced all of them to mark, this is what banks do. Banks take in deposits and then they make loans, right? So it all comes down to, what are those loans? What are the assets that they're making? And by and large, if you're looking at a period of time of, we're talking 20, 35 years of falling and reducing volatility interest rates, they were extending duration. We all know this. For many years, people were looking at these low interest rates, negative yielding interest rates. There were junk rated companies in Europe that were getting negative yields on their bonds. You had some emerging market countries that were issuing 100-year-old debt. Like, this was a bubble. It was an enormous bubble, right? So these banks were sucked into that. Okay. And so now they are being forced slowly, thanks to the Fed move, to realize these losses. They're going to start to move these held to maturity assets. They're going to recognize these when they try to sell them, and they're going to recognize the fact that they're already insolvent. I don't know how many, but it's a lot. Now, does that mean the end of the world is here? I don't think so. The big question is counterparty credit risk, because as soon as, like, one of these big banks goes down, it becomes very complicated for the Fed, FDIC, other regulators to come in and try to plug the hole on this. Like, how do they do that? Do they plug the bank? Do they, like, capital infuse it? It's very complicated to go through these enormous banks and be able to prevent the counterparties from failing, because they can't have too many of these big ones fail. If that happens, then you get financial crisis scenario. But in the near term, I think it's slow bleed. And so you get these banks failing slowly, but we're talking maybe 1,000+ banks. I'm totally guessing on that 1,000 number, but insolvent banks, because they already suffered the losses. They just haven't been forced to realize them yet. Now, what does that mean in terms of credit contraction, money supply, all that? So there's a few narratives. One of the narratives out there right now is that because the Fed's balance sheet increased by $300 billion, that, the Fed's pivoted, and now we're having more liquidity in the system. And so buy risk assets. I don't think that that's completely true. I think there's huge caveats with that. One is that because banks that are getting this capital are taking on 4.7, 4.8, 4.9 interest to cover extremely low savings rates on their savings accounts, that they're not using this money to lend out. So the money multiplier effect, which comes from banks lending more, I think is actually going down, at the same time that the Fed is printing money to infuse these banks using this, like, par borrowing scenario. So I don't see that. And you can see that in financial markets right now, where the junk bond ETFs are falling, but the long duration, low credit risk companies like Microsoft and Google, they're going up. Why are they going up? Because the discount rate from the falling 10-year, the 10-year tanked. And so you're seeing that long duration assets like gold, silver, also even crypto, right? Those are going up. Those don't have credit risk. Ethereum and Bitcoin don't have credit risk. Google and Microsoft don't have near-term credit risk, so they're benefiting from this. Whereas companies like Invitae and some of these like ARC funds, like that, maybe they're not profitable, but high duration, but their borrowing costs are going up because it's not just junk bonds. It's also private equity. Basically anything that's like high risk, that's getting tougher and tougher. And so their valuations are going down at the same time. So I think we're heading toward a much higher recession risk given this. I think that this is deflationary in effect, and I don't see liquidity going up. And I think that the Fed did what they had to do given the scenario, but I also think that there's potential for systemic risk if there's counterparty credit risk contagion from bank failures, given the inevitability of some of this mark to market of long duration corporate bonds that are most of the financial system minus real estate. That's my thesis. What do you think?